right, good afternoon, good late morning in Chicago. It's 11:20 Chicago time on December, I believe, 10th, 2025. This is a 15-minute chart as far as that goes. So um, um, this is really a good chart to have an understanding with. Um, and what's important to understand what the story is. And the story tells us something interesting. So when we first look at a chart, we want to see what the trend is of the markets. The next thing we want to do is what the background of the market is. So trend is something that's a little bit longer term. Background can be a little bit longer term, but it's mostly shorter term, maybe over the past several days to several weeks. Trend is more months and years. So this is a 15-minute case. This is a 15-minute case. So chart. So the point is that we see the markets and we want to know who's in control, the buyers or the sellers. Well, if I go back in here, I take this market up. We've had a run up, very nice. But we get this high volume here. This high volume represents the funds and the specs buying the market. So that's a bullish sign, but we don't want too much too fast. We want to be more of a grind higher, and we'll watch the demand as far as that goes. So this bar happened to be, we'll take it a little further, this market happens to be in somewhat of a down move channel, down overall, as you take it. So the reason why I mention it to you is I go back here is that this becomes a probe of any market resistance area. So we see there's a probe that the market then upthrusted this previous high. So this previous high makes a new low. To a wyckoff student, it's a very important level to the market, the high before the low. But the more important high is the one here, because this is the one that starts markdown phase. So we have different trade ranges. So there's a markdown phase from here, and we draw the line across. The larger the length of the bar, the more significant the area becomes. Okay? So this is a markdown bar, even though it's not the lowest low. So we have markdown bar and then a lower high. So this high is a reactionary high that makes a new low. But if you take the larger picture, it's this area that becomes the more important one. So what does that mean? We take this high and we take that high and we see a area of the market. Because in Wyckoff, we don't have one point, one price to break out. Okay, we have areas that the market overtakes. So we stop at the first resistance, we go sideways, and then we test the important resistance area here. And we get a break, but not selling. But then we get the upthrust. Remember, secondary tests are very, very important. We get upthrust of gold. That puts gold as a negative position. Now, the market isn't now, what we see now is that we take this low here, and now we have a form of trade range. Okay? And do a 4 and 4. Now, this is currently at. So in the short term, the market can give us some action. In the longer term, we don't have that edge. Longer term, our edges is at the low here, but short term, we're developing these springs here. A spring is a market that goes underneath the low and finishes above it. So a market that finishes underneath a previous low and above it, that's a spring. Market goes above it, that's a spring. Okay? The problem is that markets that have these springs that come from weakness tend to make new lows. They're probed to go lower ultimately. So it's a very high level Wyckoff intelligence to try to buy springs and downtrends, even though Wyckoff allows you to buy them. But for the most part, we want to stay away from them. So the current chart, if we take it on a smaller basis, that we take the market that shows selling right here, we mark that bar across, and the market shows buying, we mark that bar across. So we have a trade range within a larger trade range. And right now at an edge, we're developing spacing. The closes when we get sideways action, the closes when we get sideways action are very important. As we develop more cause in this trading range, the more cause goes under the principle of cause and effect. The larger the cause, the larger effect of the market. We could tell when the market's about to break out is that we see either high-end closes near the resistance or low-end closes near the resistance. When we see high-end closes near resistance, that's absorption to go higher. If we see low-end closes near resistance, that's generally distribution to go lower and goes back to support. So that's how you can tell if the market's about to break out of a range of the closes near the creek and the ice area. Also, if the market goes above a previous high, you will tend to get increasing volume because this is where the funds come in. Funds tend to buy new highs and sell new lows. So they are after the fact that the market's moved of what to do. Well, in this range, we have a trade range within a trade range. And right now we have a small upthrust of the market here. And now the market's developing the cause sideways. So that's where the market is as far as that goes. So what we see is that we don't have a trade today. The only trade you could have done, because you have buying here, is to buy the market here, but you'd be out on the retest up here. Okay. So that is important. Now, this is a different chart, MCX. I know that is not COMEX. If I go to a COMEX chart, I don't know why that changed. We'll see a little different action on a 15-minute chart. Okay. So let's just take that 15 minutes. We see the longer term. Let's go back what the COMEX chart says. So we have a reactionary low here with high volume. We want to mark that immediately. We now have a retest. Since this market had buying here, we'd want to buy this market here. But the market did not give us really the opportunity to spring, so we did not have a trade setup. The trade set that we see on a 15-minute chart will be right here. This is a spring of that bar. Did not make a lower low to show some strength in the market marks up here. So the trade that you have today is to, at the development of cause, is to buy the spring after a demand bar. Because you see the good volume here. You see a spring here. A light volume spring on a retest is bullish. Because it shows the lack of supply to the downside. So that's very, 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 very important. Very, very important. So in this particular case, the market is trying to absorb the selling at this point here. And we're not running away from that area anymore. When you don't run away from the area of resistance, the market is absorbing that resistance. That's what gold is trying to do now. But unfortunately, you have an FOMC meeting, Open Market Committee, about interest rates in the U.S. today, which may make the market go a little bit more havoc that goes on. But when we see a story, we want to see that sideways trade range to give us the cause and the effect of the markets. And the longer you go in that trade range, the larger the potential move can be. So we always look at that. If you can buy a market that shows buying tails, this example of a chart that shows buying tails, so a market that goes down, it goes higher, buying tail. It's like a spring almost, buying tail. This is a little buying tail. Even though we not spring it, a buying tail would be a market that goes lower and then closes high, goes lower and goes higher. That's what we call the accumulation process. To see I'm buying any weakness, close the market on its high, and that's how you can tell accumulation. Okay? The absorption process is when the market is going sideways or slowly grinding higher. They don't really have necessarily that break to buy. That's the accumulation process, but the market kind of grinds higher. A little bit different in schematic, but nevertheless the same thing ultimately for our echoes. So we want to be at a point to where we see the story of the market. So we have a longer story, which is bearish. We got a short term that's bullish. The longer story tells us what's happening, but we can scalp off the small time frame And in other words, even though we're bearish in the background, we do have enough evidence of a market that breaks tail, tail, tail. This was a spring to buy because my risk is down to here. I cannot buy this market here. Why? Because if I buy it here, my stop has to go under here. It's too large of a stop on a 15-minute chart. So this one, buy it here, I can put the stop here and have a good risk reward ratio to what happens. So markets weak overall. The 15-minute chart has shown some buying tails. I would buy the breaks to support, and I would sell upthrust and resistance is the way to play the gold market today, and wait for some upthrust of the 42.36 area, or 4.6 area actually, and see if that happens, or a spring underneath the 416 area, 20-hour range. And that should give you a play in the market-wise that should be able to give you a scalp. Remember, the closes near resistance generally tell us the direction. A high-end close in the right-hand side of the trend range would be absorption. Low-end closes, my term, would be that reverse absorption. And it would give you a clue of which way the market's headed. A market can be bullish. A market can be bullish and still go through the period of short-term distribution. So the stock market monthly chart is bullish. The short-term time frames are turning a tad negative to the market. That turn negative to the market could lead us to an area of support on the longer-term basis. And not the short-term, so we don't care about the little jingles about a particular report. We don't care about the little jingles about a particular report on the larger time frame, but we certainly care about them on the short time frame because they will jab us out. So days on 15-minute charts to get jabbed out, you still don't have to give up the edge to those charts. Buy the price that you want to buy that price. Put your stop in appropriately. On a lot of 15-minute charts, you'll get stopped out on 5 trades. A couple trades that will get stopped out. Don't be discouraged because overall, if you have 2 out of those 5 winning trades, you'll make money because of the money management to the market. You may lose a small amount on 2 of them, make no money on 1, and make decent profit on the other 2. It still leaves you only right 40% of the time, but your greater wins are betting your greater losses. So we try to, if we want to buy a spring that shows background bullishness, that is the way that we want to be. Buying a spring that shows background bearishness, if you're entertaining of buying it, you have to get it almost immediately as a scalp. So up here you see these low-end closes here on the gold. This is a little bit distribution to the market. So, and if you notice here, these 3 bars, 1, 2, and 3, each bar is substantially shorter in length. That's a shortening of the upward thrust. Small bar length. Shortening of the upward thrust against a resistance line right here is bearish and leads you lower. So remember, large bars, large volume always get marked. Cluster areas always get marked. Retest of areas, the first retest failed around 80% of the time. And then when you get the third and fourth retest, you want to see those closes, high end for absorption, low end for distribution. And the same is true on the support area. So that's very key in trading these charts is to get an understanding of story and background, trends, and the immediate action of the market of where it's at relatively speaking to the charts. Many times you'll take a 15-minute chart, you'll extrapolate that to a half hour to 60-minute chart to give you more of the basis of the story. But remember, if you're trading a 60-minute chart, your stop tends to be a little wider because your reward is wider. On a short-term chart, you can't afford to be wrong larger amounts because when you make money on scalps, the scalps will not make up what you're losing on the larger term frame if you don't have a proper risk management. So the point is, though, that people tend to take larger hits on small time frames because they don't want to get out. They'll take the small profits, but they'll let the larger market rule. And in trading, the longer the time frame that you can go in markets, the better off chance you get of success because you eliminate the acute news items that takes place. Those acute news items can be very bullish markets. Like today, for example, you make it a very bullish market, a bearish market, stock market, FOMC can make it bullish, or vice versa. So keep in mind that the news will give you an acute reaction to a market. And for short-term frame, that acute reaction to markets will wipe most people out with stop loss orders. So if that's where we're currently in gold, you can see the analysis so far is correct. A short end of thrust, but the selling low end close, and so far low end close in gold. Would expect the market maybe back to the 42.16 area or the 42.20 area in this area by the time it's all said and done. So important to understand to get the feel of the market, and that's very very important. So that's a little synopsis of what's happening there, and hope you enjoyed the little 15-minute gold presentation. And have a great day, everybody.